So I have been continuously telling back to back in a few shots recently, there is a possibility of market crash. In the sense, the market may correct to a substantial amount. This I'm talking about the global market, wherein that impact can easily get into India as well. Because mainly the probable correction is going to happen in the US stocks because of recession or other high debt issues which they are currently facing. Even the tariff and all other things are cover up of such high debt, or the efforts are to make US recession proof. But probably it is going to fail and probably the recession would hit, and if US sneezes, the whole world gets cold. That is known to us. So India is one of that. But then India is having the highest growth of GDP rate, and also if you see, it is considered as a stable market. So foreign institutional investors or the foreign investors is actually looking at safer assets. That's why they invest in gold or even they invest in treasury bills, wherein they consider it much stable compared to the highly volatile equity. But then in the equity space itself, Indian market is actually a stable market with a steady return. Even though there is some overvaluation in the Indian equity, Indian stock market, it is still not in a bubble stage. Unlike US stocks, like almost the majority heavyweights like Amazon, Netflix, Tesla, Apple, Meta, which is Facebook, all these are having almost 35 to 40% of the market cap of the entire S&P Global, which is one of the indices of US, just like our Nifty. So a few stocks is having an AI hype, artificial intelligence hype, and they are having the highest market cap because majority investors have invested in a few number of stocks, which is kind of bubble. So they are highly overvalued. So anytime if some trigger comes in, they can crash. So if they crash, then it will bring down the entire US stock market down, which will impact all other markets. But then because of this so-called stability and consistent returns in Indian market, the FII flow, which is currently at all-time low of around 16% from the earlier around 21%, can reverse. Currently, if you see, the DIA is holding more than 18% and FII is holding only less than 16%, which used to be the other way, wherein FII used to hold higher percentage of Indian equity market and the DIS used to hold lesser. DIA in the sense the mutual fund and other Indian institutions. This shows how our mutual fund inflow, SIP inflow, is helping the DII to stabilize the market, even though FII is selling every day. So this flow can reverse. So we have a silver lining here, wherein because of the attractive market and the good GDP growth rate, and if the government takes some more effort to bring in better reforms, then this can completely reverse the FII outflow and it can take our markets to higher levels. But you should be choosy on your equity stocks which you are choosing. Definitely follow value investing principle and ensure that you buy it at a better price, at a lesser price, so that once the market goes up, you get the advantage of profiting from that lower price buy of that particular stock. See you next video. Till then, happy investing.